Crazy days. The S&P 500 erases another 7%. Everyone's talking about a credit crisis. And basically, this looks a lot like 2008. And price has dropped down to the panic zone. Let's have a look. Trade of the week, the long trade hit its stop, unfortunately, and we went short. And the short trade has been coy, especially after it was announced that there was going to be a stimulus package, QE package of 50 billion, I believe was the number that they quoted, which is really more of it than anything. And trade point at 355. So I will put up those numbers on a screen in a minute. But I'm also trading about 60% heavier than the original trade. Not a martingale, just going with the probabilities. Short is more likely than long. Although at this point, with all of the fluctuations that we've had, anything's possible. Yeah, it's pretty nuts. I haven't seen anything quite like this in a while. All right. Let's go to the trade of the week and try to put those numbers in. I haven't had a chance to do that yet. All right, that is old news, and I'm going to just do that. I'll set my stop here. Just above the band with 68.66. I'll make it a nice angry red, as all stop lines should be. There you go. Trade of the week, starting March 12th, is short Aussie yen, where we hope to get at least to 65.3. If it doesn't happen, I may be tempted just to cut bait and look at something more interesting, because I think it's fair to say we're in a different regime. The market is not going to be placated by small tokens, and I suspect we're going to be floundering, wallowing in these depths for a while. Possibly several weeks, possibly several months. It really depends on how bad coronavirus gets, and I don't think anybody really knows that at this point. I think it's fair to say that the response to the disease in Asia was a lot better than it has been in North America, and I don't think people are taking it very seriously here, or as seriously, although on Twitter there's definitely a lot of fear. So And things are getting canceled. The NBA canceled their season, which is remarkable, and other sports associations are going to have to consider the same thing. Airlines are going to be hard hit. They're flying planes empty right now, apparently. I can't believe it, but to keep their positions, uh, I don't know how any of this works, but to keep their positions in line or something, they have to fly these planes with no passengers. That is nuts. Doesn't make economic sense, doesn't make ecological sense. Uh, just shut down, I would think. Anyway, that's the trade of the week. Hasn't gone well. Not a good week. So it's probably good that absolutely nobody follows me. Absolutely nobody watches my videos. Am I bothered? No, not yet. Let's talk about how things work. Today's principle is cui bono, which is Latin for who benefits. Who makes money trading? Who trades? Who are the main players in the worlds of Forex? And I just realized something. I really need that. Really need that tab. You can see I've been looking at chess. Not unusual. Organized today. Also not unusual. Okay, gotta take this down for a second. Whoops. Oh man, it just takes the whole window. Okay, gotta snap you out. Then do that. Then do that. Okay. By looking at who makes money in Forex and who mostly loses, we can get a good understanding of how the industry works. Understanding why people make or lose money and what their motivations are for trading is crucial to making good decisions. The apex predators in the jungle of Forex trading are the big banks that make up the backbone of the interbank FX market. In the ecosystem, the people who basically never lose come hell or high water, which is why their stock prices are ordinarily high. The FX market is divided into what they call levels of access. And if you go to the Wikipedia article on foreign exchange, on the foreign exchange market, which you should definitely go read, I find it amusing. The article states that the stock market does not have levels of access because it sure as hell does. Have you ever placed a trade in the stock market on a Saturday? Then you are cut from a different jib because I've never been able to do that. Most retail traders don't have that kind of access. Yet it happens every weekend, as anyone who looks at a stock chart can see. Have you ever cleared a transaction in a dark pool? Me neither. And nor will I until I'm trading millions of dollars worth of stock, which isn't going to be anytime soon. All markets have levels of access, and just like everything else in life, the rich have better and more privileged access. The foreign exchange markets are sometimes rigged, as you'll hear in the news and continually hear in FX forums. But really, the bigger problem for any trader is not the illegal collusion or the opening day fix collusion, but the fact that you're competing against giant machines like these guys. The above three banks make up more than a quarter of all the liquidity available to all the trading entities in foreign exchange. If you've ever blown an account, there's a good chance that some of your cash ended up safe with these guys. You might logically think of them as your opponents in the game that's trading, but without them, there would be no game to play. Basically, they're the only game in town. Every company at every level of access goes to these behemoths, cap in hand, begging for their liquidity so that they can be the counterparty to millions of trades that get placed every day. These guys accept the risk because they can and because they know that in the long run, the house always wins. And it's interesting to note that the fourth largest counterparty here, XTX, isn't actually a bank, but a market maker. And they've been taking market share away from banks every year since they started. So the landscape is slowly evolving towards, I think, big market makers like these guys, away from banks, who are maybe either they don't want the risk anymore or they are hampered by the regulation, the extra regulation that they have to go through. I don't know. It's a very complicated industry, and if you ever go to any of the industry sites whose URLs escape me at the moment, um, it's a whole other world. It's just amazing the sophistication that exists. And these people are pulling the best and the brightest right out of university every year. And I think it's amusing to me that retail traders think I'm gonna beat these guys. I have a strategy and I'm going to win against them. Take their money away. Drain the banks. Good luck, because you're gonna need it. So here, Goldman Sachs is more of a securities dealer than a bank. You can't really bank with them. You can buy securities from them. The same with HC Tech, and the top tier interbank market accounts for about 51% of all transactions in Forex. So every time something like Baby Pips tells you that the market is $5 trillion, or that the retail segment of the market is 300 to 400 billion dollars, it's still half of it is just uh, interbank transactions, banks trading with each other for one reason or another. And then the other half, or a little less than half, because the retail market makes up some portion, but the other half is commercial hedging. So really, the retail part of the Forex market is pretty minuscule. So what's a commercial hedger? The example of a commercial hedger that everyone cites is the farmer who grows a crop and wants to sell it for the price that they could get now when the crop comes due. That's the original, that's the origin story of futures markets. But of course, farming isn't even close to the only hedging activity. Um, you got exporters and importers who need to protect against foreign currency fluctuations, food processing, natural resources, a whole bunch of other things. Now, these entities are not interested in profiting from changes in foreign exchange prices. They just want to offset their risk, and so that they know what the price is. They need fixed prices so that they can balance their books and make projections and do business. All they want is to break even, and that is what allows big speculators to basically have a chance to profit, because they know how these companies think and they can work in opposition to them. So, I mean, without commercial hedging, the FX market probably wouldn't work. It probably wouldn't exist, at least from a retail speculative point of view. Um, National banks play a very important role in the foreign exchange markets. They try to control money supply, inflation, interest rates. They often have official or unofficial target rates for their own currencies, for their own nation's currencies. Um, they use their often substantial foreign exchange reserves to stabilize markets when things are going crazy. Um, but the effectiveness of central banks stabilizing speculation is doubtful, because central banks will not go bankrupt if they make large losses as other traders would. There's no convincing evidence that central banks make a profit from trading. Uh, and I guess one of the most famous examples of central bank stabilization that failed was the bank run, not bank run, but the George Soros led uh, cornering of the pound. Very famous story, which I'll talk about later. Um, price fixing, not what you might think it is. It's not illegal. But fixing is the idea that central banks use a fixed time and exchange rate to evaluate the behavior of their currency. So fixing exchange rates reflects the real value of equilibrium in the market. Banks, dealers, traders use fixing rates as a market trend indicator. And the term fix is used in the sense of, holding something in place, keeping it stationary, not criminal deception. But it's funny that I mentioned that because there may actually be some criminal deception in how the Forex fix may be rigged. This is from 2019. Forex market is colossal. The root of the problem is the currency fix. The closing currency fix refers to benchmark foreign exchange rates that are set in London at 4 p.m., known as benchmark rates. They're determined on the basis of actual buy and sell transactions conducted by Forex traders in the interbank market during a 60-second window, 30 seconds on either side of 4 p.m. This is why almost every broker shuts down briefly during the day turnover, and spreads widen a lot because they're looking at these fixes and trying to decide where their pricing engine is going to settle for the rest of the day. They're used to value investments, and what happened was these guys were using instant messengers to collude on sharing proprietary information on pending client orders ahead of the 4 p.m. fix. And they call themselves things like Bandits Club and the Cartel and the Mafia. They know they're bad guys. And they call it banging the close, which refers to aggressive buying or selling of currencies in the 60-second fix window using client orders stockpiled by traders in the period leading up to 4 p.m. It's basically like front running. And front running in Forex is not technically illegal because it's not considered an investment product. And so it doesn't have the same rules and regulations that govern financial products. If you're interested in more, you should definitely check out this article. It is interesting just to see how things work at this level. But yeah, they're aware of it, and this happens periodically every year. There are scandals like this one, and then they pay big fines, which barely covers the amount of profit that they make, or the profit they make is much bigger. So there's no incentive to stop doing it. For the retail trader, I guess the thing that you need to know is you should definitely not be placing trades at the end of the day. And definitely not at the beginning of the day. I couldn't find out how smaller banks use FX markets. They're mentioned in the Wikipedia article, but I just don't know. I assume they're also hedging against investment risks, against client risks as well. The next big group are large speculators, pension funds, insurance companies, mutual funds. For some reason, retail FX forums always include few people who think it's possible to find out how these big market players are aligned and then to trade with them. But I don't bank on it. Big funds like the Quantum Fund and Renaissance Technologies are included in this group. And unlike retail traders, they get very tight spreads and very good prices since they trade large volumes. They have the fastest connections to the internet. They have priority placements, first look, and things like that, which we'll talk about later. Investment management firms. not, I mean, conceptually not that different. Um, but they're managing money on behalf of rich people. When you're really rich, you don't waste time and money trying to get richer. You hire a company to do it for you. And then those companies will speculate in foreign exchange when they think they have a reason to do so. The retail speculators, people like me, probably you, believe it or not, there's a level beneath the retail speculator in foreign exchange. People who go on vacation and need to change their money at the airport, or anyone unfortunate enough to buy something in a different currency using credit cards, PayPal, and that kind of thing. Of which I mean, you and I are probably those people too at certain times. But us sad sods, they pay as much as 300 pips for an exchange rate, and even more, which is shocking when you think about when you get into retail, like when you've been trading for a while and you understand what the value of a pip is. 300 pips is an insane rate. It's thievery. It's outright thievery. Um, but compared to everyone else above us on the totem pole, retail traders get the worst spreads. They pay swap rates that are often ridiculous, should be probably illegal, and they're not expected to do anything but lose, and they rarely disappoint. Yeah. So, who would take these trading conditions? People who are either ignorant, desperate, crazy, or a little bit of all three. Um, your role in this machinery is to provide liquidity and to provide profits for your broker. Um, most retail traders think they're smart, and they may be, but you're just one isolated player, possibly a small group of players in an ocean of sharks, very well organized. A good metaphor would be an open canoe sailing across the ocean trying to brave storms with 18-meter tall waves, where your competition are sailing ocean liners and luxury yachts. And thinking on that, I'd say your real odds are probably even worse, since a canoe is at least suitable to the purpose of floating on water, while an inexperienced retail trader is more like a sieve. They don't float. All right, that concludes the educational portion of today's broadcast. Now it's the self check in.